Now, talking of invoice, we've got two types of invoices. One, I said first that invoice is issued by the seller of goods. So if you're the one selling, you will issue. We have issued. If you buy from somebody, he will issue you. So to you, you'll be receiving. You have received invoice. You will receive because you purchase. So it's also called purchases invoice. Purchase invoice. And it's coming to you. So it's incoming. An incoming invoice. Now the issued one, you issue because you sold. So it's also called sales invoice. Sales invoice. And it's going out to the buyer. So it's also called outgoing invoice. So get to know those names, not to be confused. You might meet them somewhere and you need to understand what they are. You may have different invoices and you'll be confused on which is which. So get to know which one is received, which one is issued, and what is its purpose in this case. Let's look at now the next part of this topic. After understanding such documents, let's understand what we call the double entry system. Double entry system. Now, this is a universally or globally accepted way of recording transaction in what we call ledger accounts or just accounts. So it helps us to know when a transaction has taken place, in which accounts are involved, which one we record information on the left-hand side, which one requires to be recorded on the right-hand side. So in understanding this, I will use the conventional format of financial statements. We have got what we call income statement and SFP. So I will start with the SFP, and I said in the SFP we have got three elements. We had assets, capital, and liabilities. So we'll be featuring all of them in our statement, and then we see how to record them and how to understand double entry from them. The general double entry rule states that for every debit entry, there is a corresponding and equal credit entry to that effect. For every debit entry, there's a corresponding and equal credit entry to that effect. So every transaction has to appear in two accounts, has effect on two accounts. That is one account where we debit the information, another one where we credit. Debiting means recording information on the left-hand side. Debiting means recording on left-hand side. And I will show you the ledger later, or the account later. Crediting means recording on right-hand side. So how do I tell when to record on the left or on the right-hand side? As I was saying, we will use the old format of financial statements, which are basically income statement or profit and loss, then the statement of financial position, to help us understand it in an easy way other than just cramming them. So I will start with my first statement that has assets, capital, and liabilities. The old day format, what you call T format. According to T format, let me take an example of XYZ Company Limited. XYZ Limited. Statement of financial position. Financial position. As at. We have the day, the month, then the year. So this is how it will look like. We'll have assets, On this side, have first non-current assets featuring here. Non-current assets, we talked about it last time in topic 1. Example is land, could have buildings, could have machinery, could have equipment. We do a column here for the amounts. So that's for land, building, machinery, equipment. Those are enough. We go to current assets, where I said the main current asset that gives birth to the others is cash, which will come last. So we'll have inventory, accounts receivables, we'll have prepaid expenses, we have accrued incomes. These are incomes earned, but cash flow has delayed to take place, so we have already gotten the right. It's ours. Then we have cash at hand, cash at bank. Cash at bank. And then we have cash at hand. When we sum all of them, we get what we call total assets. Now this side is called the debit side. DR stands for debit. We got the credit side, the right hand side, where we call it credit, CR, that's for credit. We have capital and liabilities. Capital and liabilities. Capital will only be one item for now. Then we go to non-current liabilities. Non-current liabilities. Examples are debentures and long-term loans for now. Then we go to current liabilities. You could have accounts payables or creditors. Accounts payables. Could have accrued expenses, like accrued insurance. Could have prepaid incomes. These are incomes you've received but you haven't earned. You can be called upon to refund. You haven't gotten right to them, but you received the money. It's a liability to you. And then we have, you can have proposed dividends. Proposed dividends. I said any proposed outflow becomes what? Becomes a liability. You can have tax payable, and we'll have to learn more as we go on. So what we get here is called total capital and liabilities. Total capital and liabilities. This one here. So it must be on the same level. Now, looking at our statement of financial position, we can see on the left hand side we have what we call assets. So I'll make a table here of an item. And then we have two effects. We can have increase or decrease. You can have an addition or a deduction in any of them. So on the left hand side we have assets. On the right hand side we have got capital and all the liabilities. Now, when assets are increasing, we ask ourselves, where are they featuring in the statement of financial position? You see that it's featuring where? on the left hand side. So when assets increase, we shall do as per where they appear. Because they're on the left hand side and they're increasing, we do what? We debit. So we shall debit when they increase. And a reduction in them will call for a contrary treatment. When they're increasing, they are found debit side, debit. When they're reducing, do the contrary. That is what? Credit. I'll talk about the increasing and the decreasing in these items. Like for assets, they increase when we acquire more. They reduce when we dispose or we sell out any of them. And then we come to capital. Capital and liabilities feature on the right hand side, the credit side. So when they're increasing, we do as per where they appear. We shall credit when they increase. When they reduce, we do the contrary, which is debiting. So we shall record the decrease on the debit side, the left hand side. That's all about the elements of the statement of financial position. We move to the next one, which is income statement or profit and loss statement. Same company, XYZ Limited, income statement. Use the word for the year ended, not as at. As at is for the statement of financial position. For the year ended, we start with the day, the month, and then the year, in that order. Again, I will use the conventional or traditional format where we have the debit and the credit side. This is not for reporting purposes, it's just for understanding the double entry. For reporting, we shall use the vertical format. So we have again the two columns for amounts. Now in the income statement, what features here is sales or revenue. Sales stroke revenue. Put it there. On the left hand side, we have what we call cost of sales. Cost of sales. Cost of sales comprises of the following: what we call opening inventory. Opening inventory. Then we have purchases. We less closing inventory. Closing inventory. What we get is called cost of sales or cost of goods sold. This is like a beam balance where we are saying this side has more weight. This side has more weight. Let's say has a weight of 100. This one has a weight of 40. We want them balanced. What do? We exact a force of 60 here so that they could be balanced. So our objective is to have them all balanced at 100, 100. So what do? We exact and equal the difference on the lesser side. So we are saying if sales or revenue are more than cost of sales, the difference is kept to the side where we have a lesser amount, which is the left hand side. For this case, we call it what? Gross profit. We had done this in topic 1 when talking about profit. So the difference between sales and cost of sales is called gross profit, and we place it on the left hand side, and from that point we ensure they are all the same. So this one is same as the value of sales this side. Then we do what we call footing. We foot it. So we shall call it gross profit carried forward. And then we come and record it here as gross profit brought forward. The same amount will feature here. Now on the left hand side, we shall add other information, what we call expenses. Expenses will come down here. But on the right hand side, we have what we call other incomes. Other incomes are incidental receipts besides the main revenue stream. We had talked about them in topic 1 we could have investment income, which comprised of dividends on shares, interest on debentures, rent on real estate property, among others. So investment income will come here. We have what you call discount received comes here. We've got something else like reduction in provision. I said also they are called what? Incomes. So after adding them to gross profit, we get what we call adjusted gross profit. We've adjusted it upwards, adjusted GP. On the left-hand side, we have got expenses, and these expenses could include, one, could have electricity, could have water, could have insurance, could have salaries and wages, could have depreciation, could have bad debts, and many others. So you can list them here. This is the amount for each. So again, we'll check if this value here is more than the sum of all expenses, so total expenses. Again, we exert a weight on the lesser side. So if this side is more than this, we call it net profit. But in case we find that the expenses were more than the GP, we'll call it what? Net loss, and we place it on the right hand side. So at this point, our income statement or profit and loss is complete. Now I want us to extract the double entry from this statement. The key items here are sales or revenue, the incomes, expenses, and purchases. I told you that purchases and opening inventory plus closing inventory, of course including closing inventory, they are both purchases, but the timing or the nature is what gives them the different names. Opening inventory are just last year's purchases. Purchases are newly bought goods in the current financial year. Closing inventory are unsold purchases. So they are basically purchases. So I will only pick purchases from this list: expenses, sales stroke revenue, and incomes. And I want us to understand the double entry for all of them. Just like the SFP items, let me do the list down here. So you have the item, you've got increase and decrease. You have increase and you have decrease. So the first one, I'll take sales stroke revenue. Number 2, incomes. Then we have purchases, have expenses. Now, looking at sales and incomes, they are found on the credit side, the right hand side. When they increase, we shall do as per where they appear. We'll do what? Credit their respective accounts. So sales increase, we shall credit. Incomes we credit. When they reduce, we do the contrary. So here we shall debit. We come to purchases and expenses. Where do they feature? On the left hand side. So when they increase, we debit. When they reduce, we do the contrary. That is crediting. Credit. So that's how we get to understand which account to how to deal with each of these when there's an increase or a decrease in either of them. Now the next thing I want us to look at after that is what we call ledger account. ledger account. Then I will do the recording of what we've just been doing here. We'll now do the real recording later after understanding what a ledger account is. Now, we have what you call a ledger. Ledgers are basically accounts where we record particular information. We can have a ledger for machinery, a ledger for equipment, a ledger for bad debts, a ledger for receivables, and many others. These ledgers are contained in a book we call what? A ledger book. A ledger book is a document or a book that has got all accounts of the firm. Now, every ledger is on its own page where information on increase and decrease are featured. Now, let me first of all show you the format of a ledger account. Then we talk more about it. An example of machinery account, machinery ledger account. We have debt this side, the details, folio, then amount, then double line. This is called debit side. Same will appear on the credit side. Debt, details or particulars, folio, amount. So this is the format of a ledger account or just an account. Now, a ledger has got, or an account has got 4 columns on either side. The first column is called debt column. Debt column is used to record the point in time when a transaction took place. And how do we record it? We normally begin by the year. An example, I'll say 2026, and then January, followed by what? The day. So I'll begin listing first, on 4th, on 5th. So we start with the year, the month, then the days when transactions took place will be listed there. Details column, or before I proceed, let me have another account called bank account so that I could explain better the details column. You have the debit side, debt, details, folio, amount, again debt, details, now details column is the column used to record the other account where double entry is completed. I said every transaction must be recorded in 2 accounts. One where we have the debiting taking place, the other one where crediting takes place. So assuming we are buying a machinery using money from the bank account of the business, one of these will be debited, another one will be credited. So details column will record the other account where similar information is featuring. Let's say we bought machinery at 3 million using money at the bank. The first thing we must ask ourselves, the accounts involved. Accounts involved. We have what? Machinery. Then we have bank. Number 2, what are they? Machinery is an asset, of course non-current. Bank is also an asset. So you must classify them. After that, we are asking ourselves, what effect has this transaction had on either of them? We are saying, on acquiring a machinery, we had an increase in the number of machines, or the value of machines acquired. Upon acquiring machines, the money at bank declined. So there's a decrease because we used money to acquire the machinery. So our cash at bank went down. What do we do? Looking at our statement of financial position, this machinery, and appears on the debit side. Because there's an increase, we shall do what? A debit. Again, bank is an asset. It appears on the debit side. Increase, we debit. But in this case, it's not an increase. It's what? A decrease. So we shall do what? We do the contrary, which is crediting. We shall credit the bank account. So, assuming it is today, 2026, let's say it's May 7th. We bought a machinery using money from the bank. So details column will have a name called bank. That is the other account where double entry has been completed. Maybe I write the double entry here. Double entry will be debit machinery, credit bank, 3 million. That's how we will record this. So in the machinery account, I will capture the day. The other account where double entry is completed, or where the information about this transaction is also featuring for verification purposes. So I'll write here bank, then 3 million. So what is the essence of folio? Folios are pages of a ledger book. So every account features on a different folio. So the folio where bank account is, let's assume is 18, this is 4. I'll write here 18 so that in case we want to prove that for sure this machine was bought on 7th using money from the bank account, I'll locate it on the bank account or bank statement on 26th May 7. I should see an outflow of 3 million. And it was what? For acquiring machinery. So it should have gone to that company where the machine was bought from. So we'll go and look at the invoices of the machine that was acquired. We check from which company, and which company is appearing on our bank statement to have received the money. And we shall prove for sure it is money that was used to buy a machinery. So you will have here page 4. So the machine is on page 4, and you can connect and find the similar information on the debit side of the machine. Now, we are saying each time a transaction takes place, it must be recorded fully. We must have the debit and credit entry. Remember, when recording the credit entry, there should be some inches from the debit entry, the second one. And the amounts also, this is called debit column, credit column. We shall do more of this as we move on, so that we get to understand more about these ledger entries. So that's how it's supposed to be recorded. Let me talk about now the ledger itself. We said a ledger is an account found in the ledger book. Pages of the ledger book are called what? Folios. So each account is on a different folio. Now, the act of recording information on the left-hand side of a ledger account is called what? Debiting. The act of recording information on the credit-hand side is called what? Crediting. So, debiting and crediting do not imply a plus or minus. To sales account, crediting means a plus. To asset account, crediting means a deduction. So the nature or the type of account involved is what will explain whether it's an increase or decrease. So never assume that debit means an increase and credit means a decrease, whichever. Now, we said recording information on the debit side is called what? Debiting, and on the credit side is called crediting. So we have what you call an account. An account does not imply a slot in the bank where we keep our money. That is just one of the forms of what an account is. So an account refers to a record of transaction, in the books of accounts. So when you make a record of a transaction, we will call it by the type of transaction. Like if you are recording purchase of goods, we have bought goods, we'll call it what? Purchase account. We shall have what you call a purchase account. So when we record this in the books of accounts, we are making what? An account on purchases. So it's called purchases account. Now let's talk about the ledger classification. Ledger classification. Ledger classification. Maybe before I go far about the ledgers, of course, the ones you're looking at here. In a company's books of accounts, we do not draw the accounts you are seeing here, the T accounts, this or the ledgers it is. They normally appear in form of statements where a plus is a figure without bracket, like 3 million. If I'm deducting anything from this account, like let's say 2M, it will appear in brackets. So if it's an asset and we see an amount without brackets, it means a plus. And then an amount in brackets means what? A deduction. So get to understand that. So for an asset, this means what? A credit. This means a debit. If it is an income account or liability account, when I see a figure without a bracket, it means what? It's a credit. A figure with the brackets means it's a debit for incomes, liabilities, and capital. So you will never see this. When you go to work somewhere, don't expect to be given books, you begin drawing these things manually. No. We have got systems where we record and everything will appear as a statement with a plus or minus in that particular account. So we're talking of ledger classification, and this is how we do it. We have got the ledger. We've got general ledger. General ledger. General ledger contains all ledgers of assets, capital, liabilities, incomes, expenses, among others. So all ledgers are found here. But we have what we call subsidiary ledgers. Subsidiary ledgers. I could call them sub-ledgers. These are ledgers that help us to determine amounts that will appear in other two ledgers called sales ledger or what we call trade what? Trade debtors. And then we have what we call purchases ledger. Purchases ledger. So we have got sub-ledgers that will give us information that we shall feed in sales account, and purchases account. They are called subsidiary ledgers. So we'll do them later as we proceed. So at the end of the period, these ones will be transferred to the general ledger. So the recording of information in ledger accounts will take the following procedure. Number one, we shall do what we call, when we'll be doing journals, we'll have what we call generalizing. And then number two, what we call posting to individual ledgers. That's why we are learning the ledger format. And then after that, we'll do what we call transfer to general ledger. So at the point where we'll be doing journals, we'll be doing what we call generalizing. These journals will give us information that we shall feed in the sales ledger and purchases ledger. So we'll be doing this in our next session. Then thereafter, we shall transfer information from the two to the general ledger. So we'll go through the whole of this process in our next session. So we looked at how a ledger can look like and how it can be classified. So we will not be doing this full ledger as it is. Instead, we shall narrow down to what we call a T account. A T account. A T account is a skeleton ledger which only has three information. We've got the date, details, and the worth The amount column records the worth of the transaction. So the worth will appear here. So we'll have it this way. Like if I'm talking of motor vehicle account, so the name should feature at the center of the account. We'll have the debit and the credit. Let's say we bought a motor vehicle using bank on 16th May. Can you still write it this way? 16th May 2026. Still is allowed. But I marked it this way. So it's still allowed. We used money from the bank. So bank. Why are we recording on the left hand side? It's an increase among motor vehicles. We are adding more. Then let's say it's 4.5 million to feature here. So this is how we'll be recording. They will have the bank account. Bank account. We'll have the debit and the credit. We'll have 16th May 2026. Have it as motor vehicle. And then 4.5 million. That's how we record the information in the T account. So we'll avoid drawing the many columns. This one becomes easy if you have many ledgers to draw. Your work becomes a bit lighter to handle. So I want to talk about some key information here for a student of accounting that you need to understand. Now, we have what you call what? Sale. Sales is the what? The worth of trading stock. Trading stock sold. Now, when we sell an non-current asset, non-current assets are for revenue generation. When we sell them, we don't call them sales. The value, the worth we get, we don't account for it as sales. So, sale of non-current assets is called a disposal. And the money or the worth should not be put in the sales account. It's accounted for us as what? A disposal. So, the accounts involved in sales, maybe give you the accounts first, will be what? Will be sales account and either bank or cash if you are receiving money. But where no money is coming in today, we have what we call accounts receivables. Where we are saying this is what? An asset. Sales, it's called asset stock, but we just call it sales for in this case for ease of understanding. So it's an income, a main revenue inflow account. So that is sales. So what is happening to bank? If you are receiving money through bank or by check, that's a plus to assets. Again, this is a receivable is what? It's an asset also. So, whichever mode of receiving money, we are saying these are what? Assets. This is sales. What is happening to bank cash or receivables? They are increasing. What about sales? Now, most students confuse a lot when you're talking about sales. Do not confuse the word sales and stock. Sales is the worth of the trading stock sold. The worth of what we so far sold. Stock is unsold goods in the stock. So when we make sales, it does not imply a reduction. It is an increase in what? Increase in the worth of the trading stock sold. So when we make sales, that's what? An increase. We're not talking about stock in store. So do not confuse sales with what is happening to the stock in the store. The stock in the store is going down. So we're not talking about that. So sales refers to the worth of trading stock that we've given out to customers. So do not confuse with what? With the stock in the store. Then also I was talking about disposal. So in this case, sales was going up, receivables or bank or cash are going up. This is revenue or sales. When revenue goes up, we credit. Assets are increasing. When they go up, we debit. So we shall debit the bank, or if it is cash, or if it's what? Account receivables, whichever is being used, we credit sales. So we'll put the amount there. What about sale of goods? So sales refers to what? I mean for goods. So you have got sale of PPE or non-current assets. Sale of non-current assets. This one is called disposal. So do not confuse the money received upon sale of an non-current asset and what? Disposal. So the account used is disposal and not sales account. So accounts used or accounts involved or accounts affected. Accounts involved, we have disposal account, then we have bank or cash. So disposal is neither an asset, liability, capital, income, expense, or purchases. What happens in bank account will guide us on what we record in the disposal account. Because money is going to increase, money is coming in. We are saying this is what? An asset. Assets increasing, we do what? We debit. For this one, we shall credit. So we said for every debit entry, there's a corresponding credit entry to that effect. So the double entry will be what? Debit bank or cash with the amount received, credit, disposal, account. This is how we shall record that. So don't confuse sale of goods and disposal of non-current assets. You might confuse them and you get into trouble causing errors. Okay, let me talk about something else. You've got purchases of goods. Purchases refers to the worth of trading stock acquired. Do not confuse it for acquisition. Acquisition is what? Purchase of assets. It's called acquisition. So when you hear purchased goods refers to purchases. Purchase an asset, that's what? An acquisition. So let's talk about purchases. Which accounts are involved? Accounts involved are purchases account, and we don't have what we call goods account. It's called purchases. We have no goods account. So purchases and the mode through which we bought them. Did we buy them using check? That's bank. Did we pay cash? That's cash. Did we buy on credit? What we call accounts payables. So the other account is for the mode of settling the or acquiring the goods. So these purchases, they are found on the debit side of the income statement. When they increase, so they're increasing. We are buying. So the worth of the goods we bought has gone up. So that's an increase. It's found on the debit side of the income statement. We shall debit. Bank or cash, money is leaving our bank, or our cash still is reducing. Accounts payables are what? Are liabilities. And they are occurring. They are increasing. Because we are buying from somebody on credit, we owe that person. So the amount of owing is going up. So all for bank or cash, let me talk about bank or cash first. We are saying they are doing what? They are increasing. So they're increasing. Sorry, they're reducing. The bank or cash is reducing because we are giving out cash. So you're saying for decrease, we shall do what? Credit. Then you had what? Accounts payables. If you are taking the goods on credit, accounts payables, we are saying for liability, and the liability is doing what? Increasing. We didn't owe, now we are owing. And increase in liabilities. Liabilities are found on the credit side of the SFP, or the statement of financial position. When they increase, we credit. So let me now give you the double entry. Purchases of goods or by cash or bank. By bank stroke cash. We shall debit purchases. So there are no goods account, called it purchases. We credit bank or cash. Purchases of goods on credit. Purchases of goods on credit. We debit purchases. We credit accounts payables. Accounts payables. That's how we record the double entry for this one. So that is for goods. What about the acquisition? For acquisition, we will not use purchases account. For acquisition of assets, we shall not use purchases account. If you do so, you've done an error. So we go to acquisition of assets. The word purchased may be used, but don't confuse that for purchases. So you hear of purchased goods, no, that's purchases. But purchase an asset, that is not purchases. We account for it as an acquisition. So accounts involved for acquisition, accounts involved. We have got the asset. The specific asset could be machinery, equipment. So the specific asset. Then number 2, we'll have the mode of paying for the asset. Could have paid by bank or by cash. What is an asset? What is this being an asset and we are acquiring more? That's an increase among assets. We are paying out money either from our cash still or from our bank. We are saying our money at bank is going down. And this being an asset, assets appear on the debit side of the SFP or statement of financial position. When they reduce, we do the contrary of where they appear. We credit. When they're increasing, we do as per where they appear on the statement of financial position. That's what? Debiting. So double entry or journal entry will be, so the double entry or the journal entry, call them journal or double entry. Journal entry, it will be, we debit that specific asset and credit the mode of paying for the asset, bank or cash. That's how we record this transaction. So do not confuse the two at any point. Now, if you hear of purchased goods by check, we don't have what you call check account. We have what you call bank account. So check signifies transaction done by bank. So do not draw anything called what? Called check account. So I want us to, maybe before I go to the double entry recording of transactions, let me talk about something else. We have got companies that trade in capital assets. An example is a kayak. Let's talk of a kayak. Or a motor selling company. For a motor selling company, to them, motor vehicle is what they are trading in. We've got motor vehicle for sale, and you've got motor vehicle for use. The motor vehicle they are using will be accounted for as a non-current asset because they'll use it for a number of years. These ones are in their store for sale. These ones are not non-current assets. They are what? They are trading stock. This is trading stock. So, if this company will buy a motor vehicle which are for sale, we shall call it purchases. But if they are buying another one for use, it's an acquisition. So the one they are using is for revenue generation. Maybe do their marketing to move from point A to point B. Those ones are not for selling to clients. So these ones are what? What you are calling acquisition. What you call purchases. Because you may get such kind of scenarios and you're like, how do I deal with this? So you could have a company that is trading in capital assets, that is large value assets. They are buying them for resale. They're not buying them for use. So those ones are trading stock. But what they are buying for use in their revenue generation or operations are called what? Non-current assets. It's also important to note that. So I want us to look at double entry system. Now the recording begins at this point. Double entry system for elements of the statement of financial position. So I have some transactions with me that I want us to go through and we see how to record them. Now these transactions, I will do them in two phases. The first phase, I will do what we call journal entries. Second phase, I will do what we call ledger entries, what we call T accounts. So I will do I will show how they're supposed to be recorded, and then I will do the actual recording in the specific accounts. So talking of journal entry, like when I'm talking of debit, motor vehicle, credit, bank, these are journal entry. A ledger entry is where we draw what? The accounts now and feed in the information. So I'll start with these ones, which we call journal entries. Then I'll go to ledger entries for you to be able to understand how they're supposed to be done. Now we have the following transactions, which were from the books of Bamboo Company for the month of August 2020X. Now, started in business with 8.5 million at bank and 1 million at hand. The money we start the business with is called capital. Part of it is in the bank account of the business. Part of it is in the cash till or the safe of the business. Now, do not confuse this with personal money. This is money of the business being held at the bank account. So, when we say began business with 8.5 at bank, it does not mean the money is leaving the owner. No. That is money of the owner is going down. We are saying the money is from the owner to the bank account of the business. So we are talking of the bank account of the business and not the owner. So in the bank account of the business, there is a plus. In the safe of the business, there is a plus. So we are saying both bank and cash are increasing based on this transaction. So do not confuse that for personal money leaving the owner. So leaving the owner is a reduction. Here we are talking of the business. We are in the business now. So in the business, we began with 8.5 being placed in the bank account and 1M in the safe of the business. So I will record them as two, and then I'll combine them. It's not supposed to record them as two, but I'll show you how they are stepwise, and then we combine them. The first one, we have got bank account. The money we use to start a business or the resources for starting a business are called what? Capital. So we have got bank and capital. Bank is an asset. Capital, we just call it capital or equity. For now, let's just call it capital. The owner's what? Contribution is capital. What is happening to bank? The bank account of the business has a plus of 8.5. That's an increase. Okay? Then money from the owner in the business is also increasing. The owner had not brought anything before. Now he has brought 8.5. That's also what? An increase. This being an asset and it's going up, we shall do what? We shall debit. Capital is increasing. We shall do what? Credit, because capital appears on the credit side of the SFP. We said anything appearing on the credit side and it's increasing, we credit. When it goes down, we do the contrary, that's debiting. Assets feature on the debit side of the SFP. They are doing what? Increasing. We shall do what? Debit. So how do you record this? We shall debit bank, that is 8.5 million. We credit capital, 8.5 million. That's how we record that transaction. We go to the second one, the money at that is the still of the business. Again, that money is what you call cash. So you have cash account and you have what? It's from the owner capital account. So this is just capital or equity. Then cash is an asset. What's happening to cash of the business? That's gone up. What is happening to owners' input in the business? He's adding money, 1 million is going up. So the owner's contribution in the business is increasing. So this being an asset and is increasing, we shall debit, because assets feature on the debit side of the SFP or statement of financial position. When they decrease, we debit. Capital appears on the credit side of the statement of financial position. When it increases, we credit. So I'll credit it. So how will I write it? This debit cash 1 million, credit capital 1 million. Now that this transaction occurred on the same day, and then led to capital, the money at bank and money at cash, that the cash at hand, they are all capital. On the same day, I will combine them into one. We are saying bank we debit bank, debit cash. Bank is 8.5. This is 1 million. All of them are capital. So I'll credit capital with the sum of the two, which is 9.5 million. That's how we record this transaction. So this is the first transaction which occurred on 1st of this year. Number 2, bought furniture. Bought furniture. So we have accounts involved as furniture, and by which mode? By check. So you have bank. So furniture is an asset. Bank is also an asset. What is happening? We are using money at bank to buy furniture. So money at bank is reducing. Furniture, we are adding more. The worth of furniture in the business is increasing. Furniture being an asset is increasing, we shall debit it. Bank is an asset but reducing, we shall credit it. So what do? We will debit furniture, we credit bank with 2 million each. That's how we do the journal entry in this case. We go to the third one, bought equipment. So because it is not goods, we mention the specific assets. So equipment, accounts involved is equipment, and the purchase was via check, 3.2 million. Again, that's bank account. So this is an asset. This is an asset. Equipment value is increasing. Bank money is going down. So being an asset and is increasing, we shall debit it. Bank reducing as an asset, we shall credit. So double entry will be debit equipment. The next transaction is bought, so that's sold what? Sold equipment worth 3.2 by check. Equipment. No, sorry, sold furniture. Sorry, for sold furniture. We have furniture. So accounts involved is furniture, and payment was by cash. Sold furniture is receiving 0.82 million. So I said when we are selling a non-current asset. What it's the trading. We are trading in furniture. We are selling furniture. It will have been called goods, but since it is mentioned as furniture, it is not goods. So we are selling it. It's not sales value. So it's what? A disposal. We are calling it disposal. Accounts involved is the specific asset and disposal account. Disposal account. So I said we cannot classify disposal as an asset, capital, liability, income, or expense. But what happens in furniture account will guide us on what we do, because for the two accounts involved, the entries are opposite of each other, the same word. So if we are crediting furniture, we debit this. If we are debiting this, we credit this one. So in furniture is an asset. It's an asset, and we are reducing. No, not really reducing. Of course, we are selling them out. We are selling them out and receiving cash. So we could only use furniture account if we had been given what? The cost. In this case, we won't use furniture account. If we had been told furniture which had cost 3 million was disposed at 0.82, then we could be in need of that furniture account. In this case, we shall use disposal account and the mode through which money was received. We received cash. So we can call it furniture disposal, to be specific, furniture disposal, because we would have other disposals, furniture disposal and cash. So it's a disposal account of furniture and cash. So cash is an asset. And we are receiving money because we have sold the furniture. Being an asset and it's increasing, we shall debit. Meaning, in this one, we shall credit. Double entry or journal entry will be, we debit cash 0.82 million, we credit furniture disposal. Not just furniture, but furniture disposal account 0.82 million. That's how we do the journal entry for this transaction. On 25th, we issued shares amounting to 4 million by check. Issued shares. For shares issued, we are raising capital. We are raising capital. So we'll have what? Capital account, or we could call it ordinary share capital account. Then we are receiving money by check, that is bank, at 4 million. I said we just classify this as capital or equity. Bank is an asset. What is happening to bank? Money at bank is increasing because shareholders are buying shares by giving us money, and money is going up. Capital also is increasing. That is how the amount owners have brought in the business is also increasing. This being an asset and is increasing, we shall debit it. For capital increasing, we shall credit. Journal entry will be, we debit bank 4 million, credit capital 4 million. That is it. The second last transaction is withdrew 2.5 million. Withdrew 2.5 million. Withdrew 2.5 million. Now, withdrawing is that what we call what? So it should be withdrew 2.5 million for office use. For office use, we'll call it drawings. Sorry, not drawings. Drawings could be if it's for the personal use. I'm doing one for office use, but we shall do others for personal use. For office use, we shall have two accounts. It is leaving the bank account, going to the cash till, so cash account. But if it were for personal use, we'll have what we call drawings account. So what is happening to our money at bank? It's reducing. The money we have in the business, in the safe, is going up. All of them are assets. The one increasing, we debit. The one reducing, we credit. So we shall debit cash account with 2.5 million. Credit bank 2.5 million. Lastly, bought motor vehicle worth 3.4 by check. You've got motor vehicle account and bank account. So all of them are assets. It's an asset. It's an asset. The worth of motor vehicle is going up, increasing. Bank, the money at bank is going down because you're utilizing it for acquiring the motor vehicle. For the one increasing, all of them are assets. One increasing, we shall debit. One reducing, we shall credit. So journal entry shall be, we will debit motor vehicle with an amount of 3.4 million. We credit bank an amount of 3.4 million. That's how we record that journal entry. So those are our what? Those were journal entries. I want now to do what you call ledger entries. We record these in P accounts. How will they appear? So we start with the first entry, so first transaction. Began business with 8.5 at bank and 1 million in cash. So I'll draw capital account. Capital account. And I'll have bank account. You discover bank account and cash are largely used, so you give them enough space. Cash account, give them enough space. And then we record the first one. This side is called debit, 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 credit, credit, credit. So first one began business with 8.5 in capital, that's at bank, and 1 million in cash. So it is on first. So first, the month is August. August 2020X. So we have also bank first August 2020X. Have it as capital. We debit bank capital 8.5. For every debit entry, there's a corresponding and equal credit entry. So here we record bank 8.5 million. And then for cash, we debit here first August 2020X. That is capital 1 million. Here again, first August 2020X. That is cash 1 million. We got the next one. Bought furniture 2M by check. We'll have a furniture account. Furniture account 2M by check. So we are debiting assets that is increasing, which is furniture, crediting bank, which is reducing. So first August 2020X, we have bank 2 million, credit bank here first August 2020X, that is furniture 2 million. Then next, bought an equipment worth 3.2 million again. An equipment was bought. Equipment account. Using money at bank. So this debit side, the credit side. First August 2020X. That is bank 3.2. So I've debited this one. I must record the credit entry first. So that was on not first, but for furniture was 5th. This 5th. Then for equipment is on 8th. right here 8th 2020X, that is equipment 3.2 million. The next one is sold furniture. I said that is called disposal, and because we've not been given the cost at which that furniture being disposed was acquired at, nothing will appear in this furniture account. We will have what we call furniture disposal account created. So furniture disposal, furniture disposal account. Then we have money came in by cash 0.82. So money came in, that's on 14th 2020X, that is furniture disposal. Furniture disposal 0.82 M. Debit here, credit here, debit side, credit side, 14th August 2020X, that is the money came in by cash, not bank. Sorry for this. Recorded here, 14 August 2020X, that is furniture disposal. Furniture disposal 0.82 million. And here right here cash 0.82 million. Then next, issued shares amounting to 4 million, receiving the inflows by check. Shares will use capital account. That is on 25th of August. So let me record for the debit entry, 25th August 2020X. We have what? Money coming in from ordinary share capital, 4 million. For every debit entry, there must be a corresponding credit entry to that effect. As bank, 4 million. Then on 28th, we withdrew 2 million for office use. That is money leaving the bank account to the cash till. So we go on withdraw. That is, we go and reduce what? The bank account, 28th. We go and withdraw the money. That is to where? To the cash till. The amount was 2.5 million. 1.5. Then we bring it here. This debits 28th August 2020X. That is bank 2.5 million. Lastly, bought motor vehicle worth 3.4 by check. We have a motor vehicle account here. We have debit, credit. It's an asset increasing, so we shall debit it on 30th. We bought it by check. That's bank. And the worth of the transaction was 3.4 million. So debit that, we credit bank on the very day, 30th. And that's the end of the ledger entries after journal entries. So you must understand how to record this. We'll get back and do what we call balancing of the accounts, and I will show you how they're supposed to be done. So for SFP, or statement of financial position items, this is how we record. We will be doing more as we do other questions, but that's the basic ones I had prepared for this. But I want to prepare others that contain both income statement information or transactions with those of the SFP so that we get to understand it better and in detail. So I've only done those for SFP, but I want to go deeper and do for both the SFP and income statement. So double entry for statement of financial position items or transactions, and those of the income statement or P&L. Let's have some transactions. There are quite a number that I want us to look at before we would look at the accounts classifications. So the first one, we're saying the following information relates to Simba Enterprise for the month of January 2026. First one, began in business with 40,000 in cash and 150 at bank. So I'll start by journal entries, and then we do ledger entries. Journal entries for all this. So I said this first transaction has two. We have got what goes to the bank, what goes to the cash. So we have both of them. I will do them as if they are one. So we have bank and cash. All of them are assets. We shall debit them. So we have got bank, and then you have got cash. This ones we are going to debit because we are saying the cash account, the bank account and cash account of the business are receiving money surplus. So for bank it's 150,000, for cash 40,000. We sum them up to form what? Capital of 190,000. That's the first one. On third, on first. On third, we had bought goods. When you hear of bought goods, that implies what? Purchases. But bought furniture, that's an asset. So bought goods, we have an account called purchases account, and mode of buying was check. So we shall debit purchases, credit bank. So for purchases is 4,000. No, this one is what? 4,000. Then sold goods to Matrix Limited. On 8th, sold goods we have what? Sales account and cash. We are selling by cash and cash. Cash is an asset increasing, we will debit. Sales increasing appears on the credit side of the income statement, we shall credit it. So it will be debit, cash, credit, sales. That is 3,400, 3,400. Now there are instances where the goods were sold on credit. In that case, here we've been told is to Matrix Limited. If it was on credit, we would mention the data in this case, who is what? Matrix. But where the data has paid, no need of mentioning the data in this case. So for this case, just debit cash, credit sales. But in other case, we'll have sales on credit. Let's know who that data is, the buyer on credit. Let's know who that is. Then on 9th, purchased goods. 9th, purchased goods are worth 7,500 by check from Tulips Limited. So because the payment has been done, we don't need to have Tulips here mentioned. So we have purchases, and you are receiving money by bank. So you have purchases and bank account. This is an asset, and money is we are purchasing, so we are giving out money to acquire the goods. So bank is reducing, we shall credit. For purchases, they are increasing. They appear on the debit side of the income statement. When they increase, we debit. So we shall debit purchases and credit the mode of payment, which is bank. That is 7,500, 7,500. Then on 14th, we have sold goods to Scorpion on credit. In this case, we have not paid the goods. We need to mention Scorpion, who is who? A debtor in this case. So it is sales. Sales increasing, we credit. Debtors are assets. They're increasing. This guy did owe us. Now he's owing us. our accounts receivables are going up and they are assets. What do? We debit them. So we shall debit Scorpion, and in brackets what? A debtor, because you could have other persons, you must know who this is. A debtor, that is 3,000, then credit sales 3,000. Then on 17th, something also happened. Paid 1,200 for insurance premiums to Jubilee. For us, since we are paying, insurance is an expense. We didn't have any expense before, so it's occurring. Because it's occurring, it's as good as increasing. So we are saying, because insurance expense is increasing, we shall do what? We shall debit the expense. We are paying via bank. Our money at bank is going down. Bank is an asset, therefore we shall do what? We shall credit it. So debit insurance, credit bank, that is 1,200. That's on 17th. Then 18th, received 15 from Scorpion by cash. 18th. Who was Scorpion? Who was a debtor? What is happening to debtors? Debtors are reducing in their assets. We ought to credit that account. So we shall debit the mode of receipt, which is cash. You are receiving by cash. Credit Scorpion, which is a debtor reducing, an asset reducing. So he paid in 1,500. That's half the amount. That's on the 18th. Then on 21st, bought goods. When you hear bought goods, that means what? That's purchases. 21st, bought goods from Kakuzi Limited on credit worth 10,000. Because you are buying goods, it's called purchases. The other account will be accounts payables because we've not paid for the goods. So the account payable is 10,000, but the person who owes us is called Kakuzi. So you'll mention Kakuzi in this case. We shall debit purchases. Purchases. Credit Kakuzi, because we could be having other creditors. So Kakuzi is who? A creditor. Creditor. And how much do we owe? We owe him 10,000. It's our accounts payable is 10,000. Then on 24th, took a loan. 24th, we took a loan. A loan is a liability. We took a loan from Diamond Trust Bank worth $9,000. So we have got loan account and it's coming in by check. You have bank account. So bank is an asset going up, we shall debit. Loans a liability increasing, we shall credit it. That is on 24th. 24th, we shall debit bank, credit, loan. That is 9,000. 9,000. On 25th, received dividends from KPLC amounting to 75. That's cash coming in. That's via check. Bank is increasing, and then dividends we are receiving are incomes. So from investments. So we shall debit bank. Incomes are increasing. Dividend income we credit it, because incomes appear on the credit side of the income statement. We credit them when they increase. 7,500, 7,500. On 26th, the second last transaction, bought machine worth 45 from Span Motors by check. We paid for them. We have a machine and asset, and we are reducing an asset called bank. So one is increasing, we debit it, which is machine. The one reducing, bank, we credit it. So $45,000, $45,000. Lastly, on 29th, we paid salaries amounted 15,000. Those are expenses increasing because we had not paid before, now we are paying, so it's increasing. And we are paying by check. Our money at bank is going down. So bank will credit, we debit salaries. Debit salaries. That is 15,000 for the debit and credit. So that is the end of journal entries on this transaction. We now want to do what? What we call ledger entries, the T accounts. We have to do all T accounts of this, after which now we shall learn how to classify these accounts, which will guide us into balancing of the account. So on the same information, I want us to draw what we call ledger entries. And as you are doing that, remember, bank is largely involved in the transaction, so create more space for bank and some also a good amount of space for cash, so that don't lack enough space to record. So I start off the ledger entries. The first one was began business with some amount at bank and cash. So you have capital account. That is capital account. So debit, credit. Then you have bank account. I told you it requires some good amount of space. Give it enough allowance. Then cash also. Some little allowance. So the first one began with what? 150 at bank. And so we must know the date of the transaction. It was January 2026 on 1st. So 1st January. So we do it like this using dots. Still allowed. Capital. That is 150,000 debit. We credit here. 1st January 2026. That is bank. 150,000. Again, he had 40, which was put in cash till. So 1st January 2026. Right here, what? Capital. That is 40,000. Then we go to the next, second one. Bought goods from Caris distributors by check. That is purchases. We debit purchases, credit mode of acquiring the goods. So we shall debit purchases by 4,000, which is against bank account. So that is on 3rd January 26. That is bank 4,000. In the bank account, I will record it on the credit side. That's on 3rd. We call it purchases. That is 4,000. The third one was bought, that is sold goods to Matrix Limited, worth 3,400 by cash. We don't have to create an account for Matrix because he paid it. We have what? Sales account and cash. We have sales account. So sales with credit, cash with debit. So on 1st 2026, right here, sales of 3,400. Here 1st January 20. On 9th, purchased goods worth 75 by check from Tulips. So we have 9 on 26th, that's via bank. So I write here bank. The worth is 7,500. The bank account, I must see on the very day 9th, 1st, 2026, should see what we call purchases. Worth 7,500. We got the next one. On 14th, sold goods to Scorpion on credit. So since it's on credit, we have to create an account for Scorpion. Scorpion account. Debit, credit. These are data. Accounts receivables. They are certainly increasing. We shall debit them. That is on 14th January 26. That is sales worth 3,000. In the sales account, our credit that day, that is 14th January 26th, Scorpion. The worth is 3,000. Go to the next one on 17th. Paid 12 for insurance, 1,200 for insurance. We create an insurance account. Our debit, then credit. An expense increasing, we debit it. As on 17th, 1st, 26th. We paid it by check. So I'll write here bank, 1,200. Then bank will come and reduce by the amount that has left. That is insurance, 1,200. We got the next one. Received 15 from Scorpion. Scorpion is a debtor. We are now reducing the amount they owe us by 1,500, and they are paying us by check. So we shall debit bank by the amount we're receiving on 18th January 26. That is from Scorpion. We record 1,500. Then on the credit side of Scorpion, on 18th, record what? Bank. That is 1,500. Then on 21st, bought goods. Bought goods stands for what? Purchases. Purchases. From Kakuzi on credit, because the guy has not paid us, we have to create an account for him. Kakuzi Limited account. And you are buying goods from this Kakuzi. Kakuzi becomes our creditor. Comes our creditor. It's a creditor. So you must note that. So it's a liability increasing. We shall credit it as we debit purchases. That is on 21st January 2026. That is Kakuzi. Kakuzi. The goods worth is 10,000. So debit here, credit the account of Kakuzi on 21st January 26. We are calling it purchases. The worth is 10,000. Go to the next one. 24th, took a loan from Diamond Trust Bank. We got loan account. Have loan account. The debit and the credit. Loan for liability increasing. We shall credit it. The money is coming via check. We shall debit our loan, our bank account. We shall debit our bank account, credit loan account. So on 24th, we've got loan worth 9,000. Then we credit it here on 24th. That is bank, $9,000. Then we go to the 25th one. KPLC dividends. You have dividend income. Dividend income account. You have debit and credit. Being an income, we shall credit it, and we debit bank because money is coming via check. So on 25th, it's a debit to the bank. That is dividend income. We received $7,500. Debit there. We credited the dividend account on the very 25th January 2026. The money came in via bank, and the worth is 7,500. Then on 26th, bought machine. So when you're being told the name of the asset, don't call it purchases. There is a machinery account to be created. Machinery account. We debit here, credit this side. So an asset increasing, we debit it. That is by check. This is the second last entry. 26 January 2026. That's bank. And the worth is 45,000. We debit here. And bank, they credit on 26th of January 2026. That is machinery, 45,000. Then lastly, paid salaries. You've got salaries account. It's an expense which now has arisen. It's now occurred. So carrying, we shall debit it. It's an expense increasing. So it's by check. We debit salaries and money leaving our bank, we shall credit the bank account on 29th January 2026. That is bank. The amount we are paying out is $15,000. The bank account we shall credit on 29th January 2026. That is salary, 15,000. So that's how we do those journal entries and ledger entries. You must understand how to do them because we shall be learning how to balance them. Okay. Accounts classification is the next thing. Accounts classification is the next thing. I want to show you how to classify accounts, and I will use this space here so that we can balance them after we are done with the balancing. Of accounts. So before we talk of balancing, we must know how to classify the accounts. Now accounts are broadly classified into two. I will do a flow diagram for ease of understanding. Accounts are classified into those that relate to persons and those that are not relate to persons. Maybe before I go far, let me remind you one thing. We have got three people in a business that are actively involved. We've got the owner of the business. We've got the suppliers who provide trading stock. We've got the customers who buy the trading stock. These are the key persons in a business. Each one of them has got his own account. The owner's account is called capital. The account of the supplier is called what? Accounts payables or creditor. Creditor's account. The account of the customer on credit is called what? Debtor. So these are the three persons that are involved in a business actively. So we have others, but these are the main ones we'll be dealing with. Now, we can classify accounts as being personal or impersonal. We've got personal accounts and impersonal accounts. So personal accounts are accounts of these persons I've mentioned. Impersonal. So the accounts of the owner, which is capital. You've got a debtor, which is a person. You've got a creditor, which is a person. Now, impersonal accounts are further classified into real and nominal. Real accounts and nominal accounts. Real accounts are accounts of assets except debtors. Asset accounts except debtors. Why are we excluding it? It's because it is a personal account. So that's what we are saying, except debtors. Whereas nominal accounts are accounts used to prepare statement of financial, statement, income statement, that is, the income statement or profit and loss. So these are income statement accounts. Which item did we see to be the ones appearing in that statement? We had revenue or sales, incomes, expenses, and purchases. So those are the ones we call nominal accounts. This is the way we shall be balancing them. So real accounts and personal accounts are SFP accounts. These are accounts of the balance sheet. So the real and personal are SFP accounts. These ones are for income statements. So SFP we have what? Assets, capital, and liabilities. They appear there. So we have the way we balance them. This one, this is the way we balance them. So let's now go to balancing of the accounts. How do we balance them? Having understood the classification of the accounts, how do we then balance them? We are saying balancing depends on where the account will end up at the end of the financial year. We've got those accounts that will end up in the SFP. We've got those accounts that will end up where? In the income statement. This is the way we balance each of them. So I will start with the balancing the accounts that appear in the SFP, which are assets, capital, and liabilities. How do we balance them? I will do an illustration for them. I will use a machinery account. Machinery account. Machinery account. So, assuming we bought machinery, let's say on 3rd April 2026, let me first of all show the opening balance brought forward, and then we bought new ones on 3rd of April 2026 via bank. This was 650,000. We bought one for 1 million. Then we had one sold out on 5th July, the very year. We had what we call disposal. One which had cost 300,000 was sold out. So, given an account, the first thing is to determine the debit total and credit total. On the debit side, we have 1.65 million, sum of the two. On the credit side, we have 300,000. Or let me use the question I've put in the notes so that it could be consistent with what you'll be doing. Just to avoid struggles for you, let me use what we have in the notes that will be posted on your LMS, that you'll be able to follow and do others the same way. We have on 1st April 2021, we had a bank 540,000. And then we have on 1st December, very year, bank again, we bought another one of 100,000. Then on 1st of January 2021 again, we had a disposal. No, it was 1st January 2022. This year begins on April 1st to 31st March. So it is okay this way. That is disposal. 75,500. So let's go by that. So debit total is 640,000. Credit total is 75,500. After that, Determine the difference in the two figures. The difference is 640 minus 75.5. That is 564, 500. This balance is named after the side with the larger total. Looking at the two, debit one is the larger total. So we'll call this what? A debit balance. Debit balance of 564. This one is supposed to be recorded on the lesser side. Look at this, it's small. We want them balanced or equal. We record it here, this side, dated the last day of the financial year. If our financial year began on 1st April, it will end on 31st March 2022. And the one we put here under details column is balance carried forward or balance carried down, which we abbreviate as BAL B/F. Balance carried forward. Sorry, it's be carried forward. C/F, carried forward. Or carried what? Down to the next year. After that, write totals on either side. The total was 640,000. Then ensure they are on the same line. Draw a double line on each. That double line is called footing. That double line means footing. We are footing an account. After that, record that balance we carried forward on the opposite side, which is this side, debit side, dated the first day of the following financial year, 1st April 2022, as balance brought forward, BAL B/F. We are bringing it forward the new year, and that is 564, 500. This account is duly balanced. It is close to zero. So balancing is the process of determining the closing figure in an account at the end of the financial year, and that figure will be used to prepare what you call the trial balance, from which we'll do what you call financial statement. So that's how we balance a real account like machinery in this context. Let's look at one for nominal accounts. I want to use the one in the notes so that when you're following the notes, you find it easy to understand them. You've got sales account. Sales account. You have the debit side. You've got the credit side. So on the credit side, we have on 4th December 2022, you have bank. And then on 1st January 2022, you have receivables. That is, we sold goods on cash and some on credit. On cash, 10,800. On credit, 12,750. We are calling accounts receivables. So we are told to balance. How do we balance? Debit total is 0. Credit total is that is 10,800 plus 12,750. That is what? 23,550. So that amount is what we want to use in getting the difference. The difference here is neither negative or a positive. We don't call it negative or positive. It's just what? Either a debit balance or a credit balance. So looking at this, the credit total is small than the debit total. We call it a credit balance. That's a credit balance. Where do we record it? on the debit side. So right here, the last day of this financial year, 31st March 2022. So we'll have it as that. So we recorded the amount on the left side on the last day of the financial year. The last day, the amount is 23,550. What do we write here? For items of income statement, we do not carry down or bring forward their balances. We transfer to income statement. So to income statement is 23,550. The last amount, the last lowest value is this one. So ensure I'm putting the total on the same line. Here also 23,550. Then I put, and that is it. We don't carry forward or bring forward anything for nominal accounts. This is how we balance nominal accounts given any kind of question. So in the questions we've done, you can attempt doing some of them. Let me do the ones I've spared here. I can balance them very quickly to sum up that part of balancing accounts. These are just around 5 of them that I want to run over. Then we shall be looking at journals, or what we call books of original entry. This is capital. Capital is, as we are assuming you're ending in December, capital is what? Part of SFP, appears in SFP. So we'll have on 31st December 2026, balance carried forward of 150,000. That is it. Then on 1st January 2027, balance brought forward 150,000. Oh, we had a 40,000 not recorded. So 40,000 that was here. 26 was our cash, which I overlooked. 190,000. Then so 190. So on 1st January 2027, balance brought forward will be 190,000. We are bringing forward what we carried forward. So now we are in the forward. So we bring it down here as 190,000. Bank is an asset, appears in SFP. We carry forward the difference or the balance. On the debit, we have 151,500. 151,500 plus 16,500. 168,000. Then we have on the credit side, we have 11,500 plus 1,200 plus 45,000 plus 15,000, 72,700. So from 168,000, we have 95,300. So on the credit side, 31st December 2026, balance carried forward 95,300. So that balance, I don't have enough space here, we'll bring it down at this point. Let me balance the cash one. 31st December 2026, balance carried forward, that is 43,400. Have it as 43,400. 43,400. So I've got some space here. We have on 1st January 2027, balance brought forward. That's what we had carried forward as 43,400. Then purchases is a nominal account. This one is for income statement. We don't carry forward. So the difference, that's 11,500 plus 10,000, 21,500. at the end of the year, 31st December 2026, that is to income statement 21,500. And that's all. We don't carry forward, neither do we bring down the balance 21,500. Then sales account, nominal account is the last one on 31st December 2026. We have to income statement, that is 6,400. So that's how we balance these accounts. We'll be doing more of them and applying. So we'll be applying them moving forward. We need to understand how they are balanced. So no carrying forward, no bringing forward. And that's the end of balancing of accounts. So the next thing we should be covering will be books of prime entry. Books of prime. Prime means main. The first place we make an entry is called books of prime entry. So what are these books of prime entry? Look at that. Now let's look at books of original entry, or what you call books of prime entry, or journals. Books of original entry. They are also known as journals. Not journal entry, but journals. Number 2, books of prime entry. Number 3, they're also called diaries or day books. Now, what are these? We've seen such documents which provide information that we're supposed to record in the books of accounts. It is at this point that we begin making the recording. That's why they are called books of original or prime main. The first place we record information is in these books. They are also called day books. Why are they called day books or diaries? We record information there on a daily basis. Just like a diary is recorded on what? On a daily basis. So they are called diaries or day books as well. Now, what are they in particular? Now, they are as follows. 1, what you call sales journal. Number 2, purchases journal. 3, which is the opposite of sales, what you call return. You sold out, you have return inwards journal. You got return outwards journal. We have what we call general journal. And then lastly, cash books. Now, the first 5 of them record credit transactions. I used to record credit transactions, where the first 4 say record credit transaction of goods. Credit transactions of goods. This one is not for goods, so that's the general journal. It's only the sales journal, purchase journal, return in and return out of journal. Those 4 record credit transactions relating to goods, but general journal does not relate to goods, but other items, like when we acquire an asset on credit, or when we issue shares. We'll talk about that one later. And it's also used for some other transactions which we'll be looking at later. Cash book is the only journal that records what we call cash transactions. Cash in, cash out are recorded in the cash book. So we'll look at that later. We have got different types of cash books and some other issues that come with cash books. We shall discuss them later. So I'll start with the first one, sales journal. Sales journal is the journal that is used to summarize information that comes from one source document called invoice. And not just invoice, but invoice that we've issued. When we sell, we issue an invoice, what we are calling outgoing invoice. So information on outgoing invoice is what shall be recorded in sales journal, only on credit sales of goods. Now, let's go through each one of them one by one. Sales journal. Sales journal. The same. Records, credit, transaction of goods sold. So people we sell to on credit are called what? They're called debtors. So these are the persons we expect to find in the sales journal, no one else. So which source document is going to give us information is called an invoice. Which kind of invoice? These invoices are numbered. So we'll go by the invoice number. So the invoice number is what we'll be recording in the sales journal. Then that shall be used for verification purposes when it comes to auditing. So let me show you the format of a sales journal. We'll have the date. Instead of details like I could borrow from the ledger account which had debt details, folio amount. For this one, instead of details, we'll have the person we sold to on credit. We call a debtor. Okay. Then we have what we call the invoice number. The source document will give us invoice number. And then we'll have our reference. Our reference, we must reference all those sales. It's the transaction number of that sale on credit. Then we'll have the amount of the last one. So this is not a ledger. It is a pro forma like document that is used to capture all people you sold to goods on credit. So this is how it looks like. Let me do the return for sales. So it's sales journal. Sales journal. You have return inwards. Journal. How does it look like? You're saying it is containing information of goods returned by who? People we had sold to. We call them debtors. So in the return inwards journal, I don't expect to find their creditor. I expect to only find people we had sold to on credit who are what? Debtors. So we'll have debt. And then we'll have debtor. It is debtors who are returning, or the customers that are returning the goods. So we had some documents I talked about when you were talking of source documents. We had what we call debit note and a credit note. Debit note was meant to correct an overcharge, an undercharge that is. That's a debit note. Whereas a credit note was used to correct an overcharge. Now, purposes or importance of credit note, one of them is to correct an overcharge, and number two is also used for return of goods. Debit note is not used anywhere when it comes to returns. It's only a credit note. So whether it's return in or return out, I don't expect to find that debit note there, because debit note has only one importance: to do what? To correct an undercharge, to top up. From the double entry, we said when assets increase, we debit. One of the assets is accounts receivable or debtors. Now you find that we have a debtor who's a customer we sold to, and we charge them less on their invoice. So we have to top up. The act of topping up an account of a customer is debiting. That's where the name debit note comes from. Now, when a customer returns goods to us, we are supposed to reduce his account. The act of reducing a customer or a debtor's account is called crediting. That's the name credit note. So returns call for reduction on amount payable or amount receivable. So here is a data. The amount to be received will be less by the credit note amount. So debit note is not used anywhere when it comes to return inwards or return outwards. It's only used for one purpose, to correct what? To correct an undercharge on a customer's account. So for both return inwards and return outwards, we'll be using what you call a credit note. So in this column, we expect to find what we call a credit note number. Credit note number. Credit note number. And then the reference of that return, then we have the amount. Okay. Next we have purchases journal. Purchases journal. How does it look like? Purchase journal. The people we purchase from are called suppliers. If we buy from them on credit, they are called creditors. So in the purchase journal, we are recording credit transaction relating to suppliers of goods on credit. So I'm expecting to find creditors only as the persons we are buying from. So we'll have creditor here. We say an invoice is used for purchases and for sales. When we sell, we issue. When we purchase, we receive from the person who sold us. So the invoice I'm putting here is the incoming invoice. So we need only the invoice number. Invoice number. Invoice number. Then our reference shall come here. The transaction number. Then the worth of the purchase will be there. That's about purchase journal. Then we have return outwards journal. Return outwards journal comes here. Return outwards journal. Who are we returning to? We are returning goods to creditors. People who had sold to us. We call them creditors. So I don't expect to find our data here. A creditor. We'll have the date. Then creditor. Then what we call credit note number. I said for all returns, both in and out, it's a credit note. So credit note number. And who issued the credit note? We said the person who had sold the goods is the one with the power to issue a credit note. That is, he's acknowledging that he or she has received the goods. So you can never issue for yourself because you are returning. You are supposed to be given as an acknowledgement that what you returned has been received, and therefore the payment will be less by that amount. So those are the first four I want to do some transactions on. I want to do some transactions, and in so doing, I want to outline the process which I had earlier talked about of recording information in journals. When I was talking about journal ledger classification, maybe I go back a little bit, then we make reference from that. I say the ledger is classified into general and subsidiary. And then on subsidiary, we said these are sub-ledgers that provide information to be used in preparing the sales ledger or sales account and purchase account or purchase ledger. So now we are there. So how do we get information? How do we record information relating to sale of goods, purchase of goods, return in and return out? Step number one. So procedure of recording information in journals. Up to what? Up to ledger preparation. Step one, do what we call journalizing. Journalizing involves preparing what? Journals. Number two, after journalizing, in those journals, we've seen we have got people which are either debtors or creditors. So we'll open the individual accounts and we transfer the information in the individual account because they'll be paying against their owing or what we owe them. So we must not just lump them together as they are in the journals. We'll put them what? In their separate ledger accounts. So we'll do what we call posting. Posting to individual ledger accounts or individual ledgers. So you must create an account for each one of them to carry their own cross on their own. After posting, we'll do what we call transfer. Transfer to general ledger. So I said what we are transferring is from the sales ledger and purchase ledger. After doing the posting, the information must be taken to general ledger where you have all other ledgers of assets, liabilities, capital, incomes, expenses. Also sales must be there and purchases. So it must be taken there. That's what you're calling transfer to general ledger. So let me do a question touching on the first four ledgers, first four journals. Then we see how they are closed at the end of the period. The question I have reads, the following info was obtained from the financial records of China's enterprise for the month of November 2025. On first, bought goods from Sterling Company Limited. Third, sold goods. So you have invoice numbers. Maybe something else about the invoices. As we are selling, we can sell to customer A, B, C, D, E. We can buy from S, T, U, V, W. These are suppliers. These are what? Customers. Now, all the cases we use invoices. But invoices from suppliers can never be consistent or sequential because they have different books of accounts. You could buy from S and you find it was 1058 invoice number that you bought from. Going to T could be even having 11,270. You began business the other day, has invoice number 74 issued to you. V could be having 820. W 418. So you can never find invoice from suppliers being sequential as in the case of customers. If today you open a business and our invoice we had was 625, the second client coming will take 626, the next one 627, next one 628, he will take 629. So I expect to find invoice of customers being consistent, unlike from suppliers, because they are different companies, you're buying from different things or different goods. So we don't expect to find this one following each other, one after the other, like it is in the case of sales. So you'll find that in this question. On first, we had a purchase of goods, 48. Second purchase took place on 8th. Invoice number is 178. The one in date 1 is 48. Invoice number for date 8 is 176. On 10th, invoice number is 89. We have another purchase on 27th. Invoice number is 89. Another one. That's all. So looking at sales took place on 3rd. Invoice number was 15. The next sale took place on 14th. Invoice number was 16. The next one was on 19th. Invoice number was 17. Next one was on 29th. It was 18. 30th, 19. So you can find that, you see that the invoices for sales follow each other sequentially, unlike from suppliers, because these suppliers are different people. Let's do the journal now, having understood. For ease of doing it, just pick out information for each of the journals in the question. Looking at this question, we have got sales, we've got return in, return out, then we have got purchases. So we have got the 4 journals to prepare. I'll do one after the other, picking information for each of the journals. I'll begin with the information on sales. So we have sales journal. Sales journal. Who features here? We've got debtors. We feature debtors. We have debt, and then data. We have invoice number. Invoice number. We've got our reference. Lastly, we've got the worth of the transaction amount. First sale took place on 3rd in the month of November 2025. November 2025, 3rd. Sold goods to Milo. Milo is the first one. Invoice number is 15. Then the worth is 23. Remember, we are only capturing credit transaction. In case the sale was partially on cash, partially on credit, we will not capture the cash one in this journal. We'll capture that in cash book. So our reference, we are saying this is the first sale in the month of November. So 1/11. Second one took place on 14th. Sold goods on credit to Sango Enterprise amounted to 88. Invoice number 16. Sango 16. Second in the month of November. The worth of the transaction is 88,000. Third one is on 19th. We sold goods to, again, Milo. 17. Third in the month of November. The worth of the transaction was 25,000. Next is on 29th and 30th. So on 29th, we sold goods to Jack and Jill. Sold goods to Jack and Jill. The worth, that's 18th, the invoice number, 4th in the month of November. The worth is 123,000. On 30th, saying we sold goods worth 40K to Rita Enterprise. Rita Enterprise. Invoice is 19. 5th in the month of November. The worth is 40,000. We can sum the total of that. That is 23 plus 88 plus 25 plus 123 plus 40. That is 299,000. Next, we go to return inwards journal. Should be one or two entries there. You have debt. Who is returning? The debtor, the guy we had sold to on credit. And then you have credit note number. Credit note number. You have our reference. Then the amount. Have Milo Enterprise on 22nd return goods. Also only one. So that is November 2025, November 22nd. Of all this, it's only Milo who returned the goods. And the goods were worth 3,500. And that's the first return in the month of November. The credit note number is 8. And that's all about the return. You got the next one, purchases journal. Purchases journal. Have debt. Details. Bit longer. We have quite a number of creditors. So details is creditors. Creditor. Then invoice number. invoice number. We got our reference, then the amount. So the first purchase, the transaction, the word bought goods from Sterling Company Limited on 1st. So 2025 November 1st, we have got Sterling. Invoice number is 48. The first in the month of November, the first purchase, the worth is 45,000. Next one is on 8th, we bought goods from Salam Enterprise. Invoice number is 176. Second in the month of November, the worth of the transaction is 75,000. Next is on 10th, bought goods from Zappi Distributors. Invoice number is 89. The third purchase in the month of November, 65,000. Next purchase, but this purchase has partially cash and partially credit, so it is 22,000 because 43 was paid. So the credit one is 22,000 from 65. Next purchase is on 27th, which is the last one. 27, bought goods from Mpasho. Invoice number is also 89. Fourth in the month of November, and the worth of the goods is 6,700. You've got return outwards. We return some goods. Return outwards journal. You got debt. Who are we returning to? To a creditor. Who will give us what? A credit note number. A credit note. So we have the number, which we shall fix here. Then we have our reference. Then the amount. So how do we record this? Who do we return goods to? On 4th, we return goods to Sterling. You have on 4th. That's 25 November. Sterling. Give us a credit note number 3, 2,000. The first return in the month of November, so 1/11, the reference. Then again, I think that's the only one. We had a return, one return for each. So 2,000. Then we had the other one for 3,500. So let's confirm the totals for this one. So it's 45 plus 75, that's 120, plus 22, plus 6.7, 148,700. 148,700, that's the value of purchases on credit. So let's do now what we call what? We've done what we call generalizing. This was step 1. Generalizing. Step number 2, what we call posting. Posting is quite a lot. Entails a lot of work. Posting. Where are we posting? 1, we are posting in sales ledger. Who are those found sales ledger? Debtors. Who are they? We have Milo, Sango. We have Milo account. A small thing, Milo account. You have the debit, credit. So, according to double entry rules, we're supposed to debit the account of the debtor as we credit what? Sales. So, the crediting of sales will be done once with an amount of the total sales to all data. So we shall debit in the debtors account for each one of them with the worth. So we have 2025, November 3rd. That is sales, 23,000. Second one, Sango account. Let's make it simpler. 311.25. And this sales account 88,000. Next we have Milo again. So Milo has two. Don't open another account. Go back to the first one. 1911.25. Again sales of the third one 25,000. Then Jack and Jill, then Rita. That's 29. That sales of 123,000. Last we have Rita. So we have Rita's account, debit, that's on 30th, 11.25, sales, 40,000. So we are done posting in sales ledger. Let's go and post where? Post in purchase ledger. Purchase ledger. Who are found there? And before we're going to do purchase ledger, Milo returned some goods. So we shall go in reverse on Milo's account on this side. That is on 22nd November 25. Goods worth 3,500. Then purchase account, we have accounts for all these. First one is Starlink account. So these are creditors, they're increasing. We shall be crediting them. The debiting will happen on the left hand side of the purchase account in the general ledger. So you have Starlink, all this we are crediting on 1st November. November 25, right here, purchases. So the other account where we shall complete the double entry from, that's 45,000. Second one, Salam account. Salam account. You have debit, credit. That is on 8th November 25, purchases. That is 75,000. Next, we have Zappi account. That's on 10th. Purchases. That is 22,000. And lastly, we have Mpasho account. Whose amount? That was on 27. Purchases 6,700. We had a return done by who? Done by Starlink. So we shall reverse that on the opposite side. That's 4th November 25. That's what? Return out. So it was return in. So return out of 2,000. So finally, we'll have what we call what? What we call we've done post. We've done generalizing. We've done posting. Final one is transfer to general. Transfer to general ledger. Transfer to general ledger. Where you have all other ledgers. We'll have what you call a sales account. and then a purchases account. For sales account, here we are debiting for all this. We now be crediting with the whole figure 1, which is 299, but one of them had a return of 35. So net of that return, we'll call them, that's on the last day of the month, which is 30th November 25, we call them sundry debtors. Then on purchases, we were crediting, or we'll debit on 30th November 25, sundry creditors. And then let's get the net figure. We have 299 minus 3.5 minus 3.5, that is 295 500. This other one was 148 minus 2, 146 700. We close at the end of the year. Nominal accounts. What do we do? To income statement. To income statement, 146 700. And also 30th November 25 to income statement. And that's the end of that part of first 4 journals. We will now be doing cash books later, the handle of cash books, then the general journal in our next session. So endeavor to understand how to record those journals properly so that you don't get confused along the way. So that's all for today. We'll meet in our next session as we do the cash books.
If you enjoyed this video, please like, subscribe, comment, and don't forget to hit the notification bell so you never miss an update.